Hello, we are the University of New Brunswick CQA team, UNB FinaStuds. Today, my team and I will share our strategies for the CQA Investment Challenge. To begin, I would like to introduce my fantastic investment team to you all. We have from left to right, Nathaniel Chamberlain, Parth Verma, Hwani Kim, and Trang Vu. In this presentation, we will discuss our investment philosophy and process, how we constructed our portfolio, an overview of our portfolio performance, before reviewing our portfolio attribution, and finally, we will conclude with our risk and return expectations. First, I will discuss our investment philosophy. The two fundamental factors we chose were size and momentum. Additionally, size and momentum possess a large negative correlation, and we will discuss all of these in further detail. To begin, we will investigate why we chose these factors. Historically speaking, small cap stocks have outperformed large cap stocks, promising a greater return comparative to large cap stocks. Small cap stocks outperformed during an economic recovery. This was discovered when small cap focused Russell 2000 surged more than 8% since the beginning of 2021, far outpacing the large cap S&P 500's 1% gain. Many studies have shown that smaller companies tend to react faster to changes in the business environment than larger companies, recovering much more quickly. To my right, empirical evidence demonstrates that the small cap stocks outperform large caps over more extended periods. Momentum. Research suggests that momentum factor has been one of the most robust generators of excess returns based on historical basis and has typically outpaced in a macro environment, characterized by long cycles and underlying market trends. Factor investing. We recognize that size and momentum are negatively correlated. Combining these two would provide us with the diversifications within our portfolio, and thus we concluded a portfolio comprising of 40% size and 60% momentum. We decided to create an equal weighted portfolio that will allocate similar weightage to every sector because our team could see a post-pandemic recovery where we could see a shift in cyclical sectors. Next, we'll discuss the portfolio construction. As part of our investment universe, we consider the Russell 2000 index. We chose the Russell 2000 index because it measures the performance of US listed small cap companies. We use the following variables to produce security selection based on the two factors. So for our size factor, we chose the variables total assets and market capitalization. And for our momentum factor, we chose relative share price momentum. Once we acquired this data for the required variables, we calculated the z-scores to standardize the data. And in terms of data sorting, we opted to go with the lower the z-score for the size variable and higher the z-score for the momentum variable. So the more attractive the security and vice versa. Our sorting is conducted at a sectorial level, and we long the top securities and shorted the bottom securities. Next, we'll speak in detail about our portfolio construction strategies that we utilize in the investment challenge. So as discussed earlier, we expected a shift to be cyclical, and thus we decided to hold on to our portfolio and let momentum play. And averted from mergers and acquisition, our team ensured that we cut loose on any positions which expected to go under a mergers and acquisition. And lastly, we made requisite trades to meet compliance requirements.
So our next section is on portfolio performance. I'll be touching on our portfolio return versus the Russell 2000, factor return contribution to our portfolio return, and factor risk contribution to our portfolio risk. Here you can see our portfolio compared to the Russell 2000 index. Our portfolio had a standard deviation of 2.33 compared to the Russell with 1.29. Our mean return was 0.04 compared to 0.31 of the Russell. Our highest single-day gain was 6.22% and highest single-day loss was 11.32%, which exemplifies the high risk, high reward compared to the Russell of our portfolio. Early on in 2021, our portfolio had a staggering 23% return. Since we saw poor performance in our factors recently, our portfolio ended with single-digit negative returns. Our portfolio was highly weighted in healthcare, which gave us a negative contribution. The portfolio was also highly short financials, but the sector ended positive for us. Consumer discretionary was a high risk, high reward sector for our portfolio and showed the most volatility of them all.
Coming to the portfolio attribution, the active return was most supported by stock-specific and industry factor, whereas the active return was imposed by style performance. Diving deeper into the active return by style, in terms of the market sensitivity, our portfolio reaped positive contribution and had positive exposure, all thanks to the low beta. With optimism regarding size factor in the future, we plan to shift from negative to positive exposure. There was a heavy reliance on momentum, and positive exposure led to negative contribution due to its underperformance. Our portfolio was exposed more to growth rather than value factor. The growth factor underperformed, and the value factor for which we had negative exposure, its outperformance in the recent month led to negative returns. Therefore, we plan a shift from growth to value in future. With mid-cap factor, our portfolio had positive exposure and negative contribution.
For risk and return, I will be talking about risk analysis, future risk, and return expectation. Take a close look in our risk report. We can see that the factor risk is very high. Most of our loss is due to the underperformance of style factors. By sector, healthcare accounts for a heavy weight and also exposed to high risk. Consumer discretionary is our most risky sector. By factor, momentum factor is highly exposed with high risk, while with dividend yield, we are losing on shorter stocks. Our portfolio had a really low beta at 0.22, which reflect our strategies of buy and hold and stay on the safe side of a volatile market. The Sharpe ratio is at negative 0.46, also affirm the low risk characteristic of the portfolio. We started with equal weight. However, our equal weight started to divert due to the different performance of different sectors and subsequent trade to keep our portfolio aligned with compliance. Looking at the future, we are considering interest rate and inflation rate as our main risk. As the economy entering COVID recovery phase, we will see an increase in interest rate, which is in favor for finance and banking sector. Going to the future, we will diversify our portfolio towards these sectors. Due to the helicopter money such as the stimulus check, inflation rate is expected to rise. Historically, small cap companies had outperformed during high inflation period. As mentioned above, our momentum factor is high exposed. If we are to continue to manage the portfolio, we will reduce the momentum factor and increase size factor of the portfolio. Although we are optimistic about the recovery of the economy, a potential fourth or even fifth wave of COVID is still there. If this happens and put the economy under a depression, the portfolio will expect a much lower return. And that also concludes our report for the competition. Thank you for listening and the opportunity to participate in this competition. It was a good learning experience for all of us, and we are looking forward to your comment and assessment.